Lesson 1. Introduction to Financial Instruments and Markets. By the end of this lesson, students should be able to describe money market and capital market instruments, including indices, calculate money market discount rates, bond equivalent yields, and equivalent taxable yields, and appraise nominal rates of return, real rates of return, and inflation-adjusted returns. The financial markets are vital for the economic growth and stability of our country and the global marketplace. These markets enable the efficient transfer of funds from those people and institutions that have surplus to those people and corporations that have productive use for it. As you will learn in this course, there are numerous financial instruments available to investors. One of the broadest ways to categorize financial instruments is in terms of when they mature. When describing the financial market in terms of time, you could broadly segregate securities as either money market instruments or capital market instruments. Money market securities have maturities of 1 year or less. In fact, most money market instruments mature within 120 days. These securities are often referred to as cash equivalents, and examples include U.S. Treasury bills, short-term certificates of deposit, banker acceptance notes, Eurodollars, repurchase agreements and reverse repurchase agreements, federal funds, money market bank accounts, mutual fund money markets, and short-term derivatives. They have low default risk because of their short-term nature and are usually sold in large denominations. The money markets provide access to short-term loans for governments and large corporations. Financial intermediaries such as banks and mutual fund companies enable small investors to gain access. Capital market instruments, on the other hand, have maturities of greater than 1 year. As you would suspect, that means there is a wide range of long-term debt, stock, and derivative alternatives. Capital market debt includes U.S. Treasury notes, U.S. Treasury bonds, Treasury inflation protection securities, also referred to as TIPS, agency debt, municipal bonds, corporate debt, and mortgage pass-through securities. Equity securities include preferred stock, common stock, and derivative products such as future contracts and options. The capital markets provide access to long-term loans and investments for individuals, corporations, and governments. Most money market instruments don't pay coupon interest. Rather, the instrument is priced at a discount to face value. For example, a $10,000 security maturing in 90 days might be priced at $9,800. In other words, you loan or pay $9,800 today in order to receive the full face value of $10,000 in 90 days. The difference between the discounted price and the face value, $200, is the amount of interest you earn. The yields on money market instruments are not always comparable because of the differences in method of calculation. Years ago, before the availability of financial calculators, dealers in the U.S. Treasury bill market had a difficult time trying to quickly quote the yield to maturity on these money market instruments. For practical purposes, they quoted rates based on the face value of the instrument rather than its current price, and on a 360-day year as opposed to 365 days. They could practically memorize a table of yields by simplifying the method. That historical method is referred to as the discount method. With the discount method, the instrument's yield for the period is equal to the amount of the discount or interest divided by the face value. This period yield is easily annualized by multiplying it by 360 divided by the number of days, i.e., the maturity. Now let's take a look at the banker's discount rate calculation for a $10,000 U.S. Treasury bill priced at $9,800 and maturing in 90 days. we can calculate the annualized yield based on the following formula. F minus P divided by F times 360 divided by N, where F is the face value, P equals the price of the bill, and N the number of days. Inputting the data, you would calculate a 90-day yield of 2%. The number of periods in the year is 4, i.e. 360 days divided by 90 days. Multiplying the 2% yield by 4 gives you an annualized bank discount rate of 8%. The discount rate or yield on a money market instrument that is calculated with a bank discount rate is not comparable to a bond. Fixed income investors want to know the yield to maturity based on the amount paid for the instrument and the actual number of days held. In order to make a comparison possible, you need to recalculate the money market instrument's yield using the yield to maturity method, i.e. the period yield based on the amount paid, not on the face value, and the actual number of days in the year, usually 365. This comparable yield is referred to as the bond equivalent yield or investor's yield. For a good explanation of the differences, referred to the explanation provided on the Federal Reserve Bank of New York's website. This website link is provided on your slide. Let's take a look at the bond equivalent yield calculation for that same U.S. Treasury bill. You can calculate the annualized yield based on the following formula. The annualized equivalent yield equals the face minus the price divided by the price times 365 divided by N, where N is the number of days. Notice that the divisor for the period's yield is the actual price of the bond, and the numerator for the number of periods is 365 calendar days. Inputting the data, you would calculate a 90-day yield of 2.04%. The number of periods is 4.056, i.e. 365 divided by 90. Multiplying those two numbers, you discover that the annualized yield to maturity on the U.S. Treasury bill is 8.27%. As you can see, the bank discount rate understates the yield. A quick word about effective annual rates. When you annualize the period return of 2.04 by multiplying it by 365 divided by 90, or 4.056 time periods, you did neglect some compounding. An effective annual rate can be calculated by using the following formula. 1 plus the period interest rate raised to the power of the number of periods minus 1. Inputting the data, you would have 1.0204 raised 4.056 power minus 1, which equals 8.536%. Now let's look at a repurchase agreement. Repos are very short money market instruments, and most are issued for a period of less than or equal to 14 days. Let's look at an example. How much would you have to pay to repurchase a $10 million security in 7 days if the cost of interest is 5% annually and the number of days in the year is 360? To solve this problem, think about the amount of interest you will be charged on a daily basis. Multiply that amount by 7 days and add that interest to $10 million. The daily interest charge based on a 360-day year would be 5% divided by 360 days, or 0.014%. The 7-day interest charge would be 7 times 0.014%, or 0.097%. That period interest times the $10 million loan would equal $9,722.22 interest. Therefore, if you receive $10 million today at a rate of 5% annually, you would owe $10,009,722.22 in 7 days. What about commercial paper? Corporations needing access to short-term funds often issue fixed income securities with maturities of under 270 days. Commercial paper is normally sold on a discounted basis. Let's work through an example. What would be the discounted price of an unsecured $1 million promissory note that matures in 270 days that yields 7% annually based on a 360-day year? The daily interest charge based on a 360-day year would be 7% divided by 360 days, or 0.019% per day. The 270-day interest rate would be 5.25%. That period interest rate times the $1 million loan would equal $52,500 in interest. Therefore, if you discount $1 million today by the $52,500 of interest charge, then the discounted price of the commercial paper would be $947,500. The primary issuers of capital market fixed income instruments are governments, local, state, and federal, and corporations. As previously discussed, there is a wide range of long-term debt securities. Capital market debt includes U.S. Treasury notes, U.S. Treasury bonds, Treasury inflation index securities, agency debt, municipal bonds, corporate debt, and mortgage pass-through securities. Unlike the money market instruments that are quite similar, capital market fixed instruments can be quite different. Maturities, liquidity risks, including default risk, interest rate risk, and credit risk, denomination size, and timing and amount of coupon payments vary significantly. Bond characteristics such as restrictive covenants, call provisions, conversion features can also vary significantly from one fixed income security to another. You will study bonds in more detail in Lesson 9 of this course. Interest or municipal debt is not taxed at the federal income tax level, and it is not taxed at the state or local level of the issuing state. Therefore, when comparing the yield of a taxable corporate bond versus a tax-free municipal debt security, the investor needs to compare apples for apples. One way to do that is to look at the tax-free municipal yield as an equivalent taxable yield. To do that, you can divide the tax-free yield by 1 minus the tax rate, i.e., the tax-free yield divided by 1 minus the tax rate. Of course, you could also adjust the taxable yield to the after-tax yield. To do this, you can multiply the taxable corporate bond yield by 1 minus the tax rate, i.e., taxable yield times 1 minus the tax rate. Either approach will allow you to compare yields on an apples-for-apples basis. Consider the following question. You are considering an investment in either a municipal general obligation bond yielding 5.2% or an AA-rated corporate bond yielding 7.5%. You are in the 28% marginal tax bracket. Which bond should you select? You are given a taxable bond yield of 7.5%, a tax-free municipal bond yielding 5.2%, and a marginal tax bracket of 28%. To make an apples-to-apples comparison, you could either compare the tax-free yield of the municipal bond to the after-tax yield of the corporate bond, or the before-tax yield of the corporate to an inflated yield on the municipal that accounts for the 28% tax savings. Let's work the problem finding the equivalent taxable yield of the municipal bond. You know that the tax-free yield is 5.2% on the municipal bond. What is the equivalent taxable yield? That can easily be calculated by dividing the 5.2 yield by 1 minus the tax rate, or 0.72. So, following this logic, you discover that 5.2% divided by 0.72, or 72%, yields a taxable rate of 7.2. 7.2% is an inferior investment to one that yields 7.5%. Therefore, as an investor, you would select the corporate bond. You were able to make an informed decision by calculating an equivalent taxable yield. Notice what would happen if your marginal tax bracket jumped to 40%. Using the same yield numbers would give you an equivalent taxable yield of 8.7, i.e. 5.2% divided by 0.6. That now compares favorably to the 7.5 corporate bond, and you would select a municipal security. Do you see how your choice would change if you were in a higher tax bracket? Equity means residual interest or claim on future earnings. Unlike a bond, where you're promising future interest payments and return of principal, common stock issuance gives away ownership in the entity. For example, a corporation, a limited liability company, a general partnership. One form of equity, preferred stock, is a stock bond hybrid. Preferred stock shares some characteristics of both bonds and stock. Preferred shareholders are entitled to dividends, although the dividends might be postponed at management's discretion. While preferred shareholder rights are subordinate to debt holders, they do have priority over common shareholders. A unique characteristic of preferred dividends is that they are not tax deductible to the issuing firm. But the dividends paid on preferred stock are 70% tax-free to domestic corporations receiving them. You will study equities, common and preferred, in more detail in a later lesson. Indexes are statistical measurements of return and risk for a group of securities. The index return is measured from an initial base value, for example 100, that was calculated on a starting date. Indexes are monitored for purposes of comparing one's portfolio to an index benchmark and for understanding price movements of general markets or subsectors. They are also used for displaying historical returns and volatility and as a base for certain derivatives. What factors should one consider when constructing or using an index? Well, first, you need to identify those securities that are representative of the index you're trying to create. For example, if you're trying to assemble a mid-cap growth index, you must address the issue of what capitalization range is mid-cap as opposed to small cap, as opposed to large cap. In this case, you would also have to identify what metrics describe growth as opposed to value. Next, you need to determine how broad you want that basket to be. Are 30 stocks, like the Dow Jones Industrial Average, enough? Are 5,000 securities, like the Wilshire Total Market Index, too many? If you are constructing a biotech index, how many stocks in the sector should be included in order for the index to be representative? Next, you have to decide upon the methodology for calculating the index value. You might use a market capitalization weighting, a price weighting, or equal weighting. We will look at weighting in a moment. For additional information, refer to an article on the Vanguard website entitled Market Indexes, Determining the Appropriate Benchmark. This article can be found at the link shown on the slide. Any group of financial instruments can be assembled into an index. Typical groupings are by market, asset category, region, or country. These groupings can be further refined by focusing on the size of the company, large cap, investment style, for example growth, credit rating, for example, investment grade, or industry. Whenever there is a need to track a group of financial securities, some brokerage will create a usable index. Examples of stock indexes include the Dow Jones Industrial Average, which tracks 30 stocks, the Standard & Poor's 500 Composite, which tracks the 500 largest companies on the New York Stock Exchange, the American Stock Exchange, and the NASDAQ, the Russell 2000, which tracks the small stocks, the New York Stock Exchange Composite, which tracks all stocks on the New York Stock Exchange, and the Wilshire 5000, which tracks nearly the entire market. Bond indexes track securities by credit rating, issuer, maturity, etc. Example of bond indexes are the Lehman Brothers Municipal Bond Index, the Merrill Lynch Broad Market Index, First Boston High Yield, and the Merrill Lynch Mortgage Index. Example of international indexes are the Nikkei 225, which is a simple average of 225 large-cap stocks in Japan, the FTSE 100, which tracks the largest 100 companies in the United Kingdom, the DAX, which tracks 30 large-cap German companies, the Morgan Stanley Capital International EAFE, which tracks over 1,000 large-cap companies in Europe, Australia, and the Far East, and the MSCI Emerging Markets Index, which tracks nearly 1,000 companies in over 20 emerging countries. As previously mentioned, you must decide upon the weighting of the components when constructing an index. Three common approaches are price weighting, market value or capitalization weighting, and equal weighting. The Dow Jones and Nikkei 225 averages are examples of indexes created with price weighting. Each security in the average is treated equally, regardless of market price or market capitalization. Therefore, in the Dow Jones Industrial Average, each of the 30 stocks has equal representation. You add the stock prices of the 30 stocks together, and then you divide by 30 to get the index value. Note that over time, the number of stocks needs to be adjusted for splits because the intent is to keep the number of stocks equal based on the starting date. The S&P 500 index, the Wilshire 5000, and many other indexes are based on value weighting. In these indexes, the larger capitalization companies have a greater weighting. You calculate the market capitalization, i.e. the price of the stock times the number of shares for each stock in the index, and then add them together, and then divide by the number of stocks in the index. As you can imagine, rather than each stock representing, say, 1/500th of the index, a large company like Microsoft could represent 10% or more of the index value. The value line index is an example of equal weighting. In the approach, it is assumed that an equal dollar amount is invested in each stock. Rather than larger companies or companies with higher prices having more influence on the index, every company's price movement has an equal impact on the movement of the index. But why is weighting important? Think about this scenario. Let's say there are several large cap stocks that dominate an index. They have very little price movement, while smaller stocks are experiencing a lot of volatility. In this case, the index doesn't move much. Is that truly reflective of the market? Well, it is if you're looking at the large cap stocks. It isn't if you're investing in the second and third tier players in each space. Do you see why it is important as a portfolio manager to have a benchmark index that truly tracks your investment portfolio? Another element that can impact the index value is the methodology for calculating returns. The index can use either an arithmetic or geometric approach. The Dow Jones and S&P 500 index use an arithmetic approach, while Value Line uses a geometric approach. The arithmetic approach simply adds up the period returns and divides by the number of periods. For example, if the security has returns over 4 periods of 5%, 10%, minus 3%, and 8%, then the arithmetic return is 20% divided by 4, or 5%. In contrast, if the same returns are averaged with a geometric approach, the return is 1.05 times 1.10 times 0.97 times 1.08, the product of which is raised to the 1/4 power minus 1, which leaves 4.9%. Note that the arithmetic approach will overstate the geometric return. You will learn about weighted returns, time-weighted and dollar-weighted, later in this course. Do you see how a fund manager, you would want to ensure you are calculating your returns in the same way as the brokerage calculates the benchmark index return? Derivatives are securities that derive their value from the price movement of one or more underlying securities. The derivative is essentially a contract between two parties, and most often there's a clearinghouse exchange in the middle to ensure completion. For example, the Chicago Board of Exchange. Options and future contracts are used by hedgers and speculators worldwide. The most common derivative products include options, future contracts, forward contracts, swaps, convertible securities, and warrants. However, the derivative market is rapidly growing. As financial intermediaries recognize market needs, they will quickly offer new innovative products. You will study options and portfolio risk management with options in more detail in Module 8. In the following series of slides, you will examine interest rates and market risk premium. From the perspective of users, an interest rate is the cost for borrowing money. On the other hand, for suppliers, the interest rate is the compensation for delaying consumption. The primary suppliers of capital are households and governments, and the primary users of capital are businesses and governments. It is the interaction between suppliers and users, i.e. supply and demand, and the market action of Federal Reserve that determine the level of real interest rates, i.e. the market equilibrium point. The Fisher equation, named for economist Irving Fisher, states that the nominal interest rate, i.e. the rate that you observe, is the sum of the real rate of interest and the expected inflation rate. The inflation premium is compensation for the possibility that the borrower's purchasing power may be eroded. So, given an environment where the real rate of return is 3% and the expected inflation rate is 4%, the nominal rate should be 7%. The investor receives a real rate of return of 3% and is protected for a 4% loss in purchasing power. Note that the Fisher equation, nominal rate equals the real rate plus the inflation rate, is an approximate calculation. To be more precise, the equation should read 1 plus the nominal rate equals 1 plus the real rate times 1 plus the inflation rate. The graphic on this slide depicts the connection between nominal rates, inflation rate as measured by the CPI, and the estimated real rate of return. As depicted, there is a robust relationship between inflation and nominal rates of interest. This graphic can be found on the Federal Reserve Bank of San Francisco's website. That site can be accessed with the link provided on the slide. The Fisher equation shows that the nominal risk-free rate consists of the real rate plus the inflation premium. But what about other interest-bearing securities that are not risk-free? Those instruments require an interest rate yield that reflects not only the real rate of interest and the inflation, but also the risk of default, the lack of liquidity, if applicable, and maturity, i.e. short-term versus long-term. You will discover throughout this course that investors demand a higher level of return for holding higher risk. Interest or dividends earned on an investment is only part of the story. You will learn in a later lesson that interest divided by the purchase price is referred to as the current yield. The holding period return or total return consists not only of all distributions made during the period, but the price paid and the current price. The formula for the holding period return is the ending price plus distributions minus the beginning price. That sum is then divided by the beginning price. In other words, the distributions and unrealized capital gains are added before comparing them to the cost of the investment. Note that you can calculate the holding period return for any time period. However, if the period is less than 1 year, the calculation will understate the annual return. If the period is over 1 year, the calculation will overstate the annual return. Let's look at an example. Consider an investment that costs $10,000. During the year, cash distributions are $525, and based on the end-of-year price, there are unrealized capital gains of $800, i.e., the ending price is $10,800. That means that total realized and unrealized gains are $1,325. That dollar return on an investment of $10,000 equates to a 13.25% holding period return. Is a savings account investment yielding 5% before tax really without risk? Not if inflation is running at 4%. Let's run the numbers. If the investor is in the 28% tax bracket, it means that the after-tax return is 5% times 1 minus 0.28, or 3.6%. At 4% inflation, you are losing purchasing power every year. You risk not keeping up with the cost of living. As an investor, you must focus on future earning power. That means understanding what the inflation-adjusted return is. Let's look at an example. What is the inflation-adjusted return for a 13.25% holding period return if the rate of inflation during the period was 8.5%? Starting with the formula, 1 plus the holding period return equals 1 plus the real rate times 1 plus the rate of inflation, you can rearrange terms to solve for the real rate of return, or inflation-adjusted return. Inputting the data for this question, you calculate that 1.1325 divided by 1.085 minus 1 equals 0.0438, or 4.38%. That means that you are earning 4.38% beyond the point of keeping up with the expected rising cost of living. Is 4.38% enough to reach your needs or financial goals? Is this financial instrument a good investment for you? These are questions that you will examine in coming lessons. In this lesson, you learned about money market and capital market instruments, discount rates, bond equivalent yields, and equivalent taxable yields, and nominal rates of return, real rates of return, and inflation-adjusted return.